One number. That's all I need. One number, and I promise you'll watch this entire video. Ready? 1. Not 1 million, not 1,000, not 100. 1, as in a single, solitary loan. The U.S. government, in response to the worst housing collapse since the Great Depression, authorized $300 billion specifically to rescue struggling homeowners. They named the program Hope for Homeowners, which is genuinely a beautiful name, Hope for Homeowners. $300 billion of hope. And as of July 2009, nearly a full year after the crash shook the entire global economy, that program had successfully helped one homeowner. One loan insured out of $300 billion. One family in the entire United States of America. Meanwhile, $700 billion in bank bailouts were drafted, debated, approved, signed into law, and dispersed in weeks. And the man who designed that bank rescue? Former CEO of Goldman Sachs. And the staffer he personally picked to administer the funds? Also from Goldman Sachs. And Goldman Sachs received $10 billion directly from that same bailout they helped design. But I'm absolutely sure that's a coincidence. I'm sure. This is not a story about a financial crisis. Financial crises are abstract, numbers on a screen. This is a story about 10 million families who lost their homes, about 7.5 million people who lost their jobs, about an average American who will lose $70,000 of lifetime income, money they will never see from a disaster they had no hand in creating. This is a story about who builds the bonfire and who gets burned. And it starts, like all the best disasters, with a feeling. Specifically, a feeling of complete and total safety. Picture America in 2003. Actually, don't just picture it. Feel it. The dot-com crash is 2 years in the rearview mirror. September 11th has passed. The economy is recovering. Interest rates have been cut to 1%, the lowest since the 1950s, by Federal Reserve Chairman Alan Greenspan. Cheap money is flooding through every crack in the financial system like water finding the lowest point in a floor, and Greenspan, the most powerful central banker on earth, is publicly, repeatedly, confidently telling everyone that markets are self-regulating, that banks, in their own rational self-interest, will never take risks that destroy themselves, that financial innovation, all these new complex products being created on Wall Street, has made the system more resilient, not more fragile.
And everyone wants to believe him, because believing him feels great. House prices are rising every single year. Home ownership is at historic highs. The financial textbooks say nationwide housing declines are basically impossible. Too many local markets, too many variables, the country is too big. The experts had models. The models said, safe. The plan was always to trust the models. The models were wrong about basically everything. But here's the thing about safety. Real safety is boring. Real safety is low returns and long timelines and patience. Fake safety is exciting. Fake safety is rising asset prices and easy credit and the unshakable conviction that you've finally figured out something previous generations were too unsophisticated to understand. And in 2003, fake safety was everywhere. Cheap money plus human optimism plus zero regulatory friction equals, well, you're about to find out. Let's build this machine piece by piece, because understanding how it worked is the only way to understand why it failed so completely, and why the failure landed almost entirely on people who never touched a single one of these products. Start with a mortgage. Simple enough. You borrow money to buy a house. You pay it back over 30 years. Bank collects interest. Everyone's fine. That's been working since basically the invention of banks. Now, what if the bank didn't want to hold that mortgage for 30 years? What if they could sell it? Package it up with thousands of other mortgages and sell the whole bundle to investors as a bond. The investor gets a return, the bank gets its money back immediately, and the bank can
issue another mortgage, and another, and another. This is called securitization, mortgage-backed securities, MBS. And in moderate doses, it works. Banks get liquidity, investors get yield, homeowners get access to credit. Fine. But then, Wall Street looked at that system and said, "We can do more." They always say we can do more. They took those mortgage bonds, the MBS, and bundled those together into a new product, a bond of bonds, a collateralized debt obligation, a CDO. Now, instead of holding mortgages, investors were holding a slice of a bundle of bundles of mortgages. It was complicated enough that most buyers just read the rating on the label and trusted it, like buying food based purely on the packaging without checking the ingredients. Turns out, the ingredients were problematic. But even that wasn't enough leverage. Because then, and this is where you need to just stop and appreciate the audacity, they invented the synthetic CDO, a product that didn't even hold the actual mortgages or the mortgage bonds. A synthetic CDO was a pure bet on the mortgage market. Credit default swaps, financial contracts, referencing mortgage securities without actually owning them. Side bets. On a game, played with borrowed money by people who collected their fees regardless of which way the bet went. The investment banks were simultaneously selling these products to clients and in some cases betting against them on the side. We'll come back to that. Oh, we'll absolutely come back to that. Here's the scale of what this became. CDO issuance, the raw volume of these products being created, went from $20 billion per quarter in early 2004 to $180 billion per quarter by early 2007. That's not growth. That's not a boom. That's a 9-times explosion in 3 years. The securitized share of subprime mortgages, loans being packaged and sold off rather than held by the lender, went from 54% in 2001 to 75% in 2006. By 2006, private bond issuance of mortgage-backed products and CDOs hit close to $2 trillion for the year. $2 trillion. And the fuel feeding this entire machine? Mortgages. Which meant someone needed to produce a lot more mortgages. Which meant lending standards had to go. And go they did. In 2006, 1/3 of all new mortgages in the United States were subprime or no documentation loans. 1/3 no documentation, which the industry cheerfully nicknamed liar loans, a term they used internally while publicly calling them alternative documentation products. Just let that sit for a moment. The industry had a nickname for their own fraud. They called them liar loans and then kept making them and rating them AAA and selling them to pension funds and foreign banks and municipal governments who trusted the ratings. The bill always comes. Somebody else just paid it. Now, who was actually assigning those AAA ratings? Moody's, Standard & Poor's, Fitch, the 3 major credit rating agencies. These institutions are supposed to be independent, rigorous, the objective voice of risk assessment. But here's the structural problem that everyone in the industry knew and nobody in power seemed particularly interested in fixing. The rating agencies were paid by the banks whose products they rated. The issuer pays model. You hire me to evaluate your product, I give it a great rating, you pay me. You bring me your next product, I give it a great rating. Completely impartial. Bulletproof system. By 2005, 81% of new CDO pools consisted of mortgage-backed securities. Moody's had rated them, S&P had rated them, Fitch had rated them. And in 2007, after the machine started sputtering, Moody's downgraded 1,655 CDOs in a single year. 10 times the amount they downgraded in a typical year. 10 times. Where were those ratings in 2005? In 2006? They were attached to products being sold to your pension fund, rated AAA, not worth the paper they were printed on. Now, let me introduce you to the people running this operation, because every disaster has architects, and these ones were very, very well paid. Angelo Mozilo, Chairman and CEO of Countrywide Financial Corporation. If the 2008 crisis had a face, it might as well have been his. Countrywide was the largest mortgage originator in the United States, the biggest pump in the machine, and Mozilo ran it with evangelical conviction, publicly championing the expansion of homeownership to Americans who'd previously been locked out of the market. Noble framing, genuinely noble framing. The product he was selling to achieve that goal was a different matter entirely. Subprime loans, Alt-A loans, adjustable-rate mortgages with teaser rates designed to look affordable until they reset. Liar loans. Countrywide produced more of these than any other institution in the country and fed them directly into the securitization pipeline. His estimated compensation over the period, $377 million. And while Countrywide was handing out mortgages like flyers at a trade show, Mozilo was quietly, systematically selling his personal stock in the company. The SEC later charged him with insider trading and securities fraud, alleging he knew the loans were deteriorating while publicly reassuring investors everything was fine. He settled in 2010. $67.5 million. No admission of wrongdoing. He kept the other $309 million. Math is a flat circle. Then there's Richard Fuld, Chairman and CEO of Lehman Brothers, 158 years old, fourth largest investment bank in America. Fuld had built Lehman into a mortgage powerhouse, loading the firm up on subprime MBS and CDOs until the leverage ratio hit approximately 30-to-1. 30-to-1, meaning for every single dollar of actual equity in the firm, Lehman owed $30 to someone else. That's not a balance sheet. That's a dare. His realized compensation between 2000 and 2008? $485 million. Lehman filed for the largest bankruptcy in U.S. history on September 15, 2008. Fuld faced no criminal charges. He's been speaking at financial conferences since. And the 14 major bank CEOs, collectively. Let's look at what they actually did with their own money, because this is the detail that should never be forgotten. Between 2000 and 2008, these 14 executives bought stock in their own banks worth $36 million. That sounds like confidence, right? They believe in their firms. Except, during that same period, those same 14 executives sold shares in their own banks worth $3,467 million, $3.4 billion in personal stock sales, buying $36 million, selling $3,467 million. If they believed in these companies, they had a funny way of showing it. The plan was never to absorb the loss. The plan was to collect the upside and transfer the downside. And it worked, spectacularly, for them. There were no clawbacks. The bonus arrangements, pay packages built on earnings that later turned out to be fictional, had no provisions to recoup compensation when the losses materialized. You get paid for profits that don't exist. The profits evaporate. You keep the money. The shareholders lose everything. This is not a bug. It was the feature. But here's what makes me genuinely want to sit down on the floor for a minute. Someone saw it coming. Someone did the math. Someone read the fine print on these mortgages and calculated with almost frightening precision exactly when they would start exploding. His name was Michael Burry, a fund manager, a former medical student who taught himself finance, who in May 2005 called Deutsche Bank and asked to buy credit default swaps against subprime mortgage bonds. Insurance that would pay out if the mortgages collapsed, $60 million worth to start. Deutsche Bank thought he was eccentric at best. Who bets against housing? Burry had read the actual loan documents. He'd looked at the teaser rates, the reset schedules, the income documentation, or lack thereof. He'd done the specific calculation, and he'd concluded the system would start breaking apart within 2 years of the teaser rate periods expiring. He was right, approximately to the month. And here's the part that never stops being remarkable. Burry wasn't the only one who knew. In May 2006, a full year before the crisis became visible, J.P. Morgan warned its own clients of a coming housing downturn, specifically in subprime. A major Wall Street institution issued an internal warning and then continued operating in the market because the fees were still flowing, because the music was still playing. And you dance until the music stops, even when you can see the DJ's hands moving toward the off switch. So when exactly did the music stop? Let's walk through it. Not as an abstraction, as a sequence of moments where the floor kept dropping. Housing prices peak. No announcement, no ceremony. They just stop going up. Mortgage delinquencies begin their quiet upward climb. The canary in the coal mine. Nobody's listening to the canary. Early 2007, interest rates have risen from their historic 1% low. Adjustable rate mortgages, the ones with the teaser periods, start resetting to their actual rates. Payments that were manageable become impossible. Defaults begin accelerating. Lenders start going bankrupt. New Century Financial, one of the biggest subprime originators in the country, files for bankruptcy in April 2007. That's not a warning shot. That's the first structural beam cracking. June 20th, 2007. Bear Stearns, America's fifth largest investment bank, receives margin calls on two of its internal hedge funds sitting on $20 billion of CDO exposure. Bear Stearns injects emergency capital. 6 weeks later, July 31st, those funds are liquidated entirely. Not restructured, not sold, liquidated. Whatever was inside them, gone. July 19, 2007. The Dow Jones Industrial Average closes above 14,000 for the first time in history. 14,041 cents. Record high. Champagne corks. Financial media celebrating. The building's foundation is cracking, and the penthouse party is just getting started. August 9th, 2007. This is the date. Write it down. This is the moment the CEO of Northern Rock, the British bank that would soon become the first British bank to suffer a bank run since the Victorian era, later described as the day the world changed. BNP Paribas, one of Europe's largest and most respected financial institutions, announces it is freezing $2.2 billion in assets across 3 of its hedge funds. Not reducing, not restructuring, freezing. Their stated reason? Quote, a complete evaporation of liquidity, making valuation of the funds impossible. Complete evaporation of liquidity. Banks had stopped trusting each other. The interbank market, the overnight lending between financial institutions that keeps the entire global financial plumbing functioning, had seized, like an engine running without oil. This was the point of no return. Not September 2008 when Lehman fell, not March 2008 when Bear Stearns was sold for scraps. August 9th, 2007. Everything after that date was a system that was already dead, just hadn't finished falling yet. March 2008. Bear Stearns, with its 30-to-1 leverage and its exposure to products no one could value anymore, is sold to J.P. Morgan Chase in what the financial press politely called a fire sale. The Federal Reserve had to backstop the deal with emergency financing. The 5th largest investment bank in America sold over a weekend. Gone. September 7, 2008. The U.S. government takes over Freddie Mac and Fannie Mae, the 2 government-sponsored entities that had guaranteed $5.4 trillion in mortgage debt. $5.4 trillion. That's larger than the entire annual GDP of Japan. The government now owns the mortgage market. Nationalization. In America. Over a weekend. September 15th, 2008. Bam! Lehman Brothers, 158 years old, 4th largest investment bank in the United States, files for bankruptcy. Not sold, not rescued. Bankruptcy. The largest bankruptcy filing in American history. $619 billion in debt. The global financial system processes this information and begins having a collective panic attack. September 16, 2008. The Federal Reserve announces an $85 billion emergency credit facility for AIG, the insurance giant that had sold credit default swaps, basically insurance contracts, on CDOs to financial institutions around the world. When the CDOs collapsed, AIG owed money to everyone: Goldman Sachs, European banks, municipal governments, everyone. That $85 billion initial rescue eventually grew to $187 billion total. $187 billion for one company that had essentially written unlimited insurance on products it didn't fully understand. October 3, 2008. President Bush signs the Emergency Economic Stabilization Act into law. $700 billion Troubled Asset Relief Program, TARP. Designed to purchase toxic assets from failing banks. Designed by Henry Paulson, former CEO of Goldman Sachs. Administered by Neil Kashkari, former vice president at Goldman Sachs. Goldman Sachs received $10 billion in TARP funds and was a major counterparty in the AIG bailout that paid out billions to Goldman specifically. The system worked exactly as designed, just not for who you think. December 16, 2008. The Federal Reserve cuts the federal funds rate to 0%, the lowest possible rate, the last tool available, deployed completely. The economy was so severely damaged they had nothing left to cut. And Federal Reserve Chairman Ben Bernanke, in testimony to the Financial Crisis Inquiry Commission, stated on the record that 12 of the 13 largest U.S. financial institutions were at risk of complete failure during 2008. 12 of 13. The entire American financial system was roughly 45 days from total collapse, and most Americans only found out years later. Now, the numbers, the real ones. Not the Wall Street numbers, the kitchen table numbers. The stock market, that record high of 14,000 on July 19, 2007, cratered to 6,443 by March 6, 2009, a 54% collapse in under 2 years, more than half of every dollar invested, gone. But stocks recover. Stocks eventually came back. Many people will tell you the market recovered quickly. And technically that's true for stocks. But stocks are not where most American families store their wealth. Houses are. And houses did not recover quickly, not even close. National home prices fell between 21% and 26% from their 2006 peak, worse than the price declines recorded during the Great Depression. The Great Depression. They kept falling until 2011. And here's the brutal math. A report released in January 2011 confirmed that U.S. home values had dropped 26% from June 2006 to November 2010, more than the 25.9% drop recorded between 1928 and 1933. Let that land. The 2008 housing collapse was worse than the housing collapse during the Great Depression. And the people who owned those houses, who had their entire net worth tied to those houses, absorbed every single dollar of that decline. Median household wealth in the United States: $106,591 in 2005. By 2011, that number had fallen to $68,839, a 35% wipeout in 6 years. Median family net worth peaked at approximately $140,000 in 2007, fell to $84,000 by 2013, and only partially recovered to $97,000 by 2016. Still below where it started. Still below 2007 levels, 9 years after the crash. Total household wealth destroyed. Approximately $17 trillion in inflation-adjusted terms, a 26% reduction in national net worth. And within that total, the Federal Reserve later calculated, just in real estate losses alone, from July 2008 to March 2009, American households lost $3.4 trillion. That's roughly $30,300 per household in real estate value in 8 months. And when you add the stock market losses, the combined peak loss hit nearly $100,000 per average U.S. household during that same period. The Federal Reserve Bank of San Francisco later calculated the lifetime toll. The crisis didn't just cost people money in the moment. Because output fell so far and stayed down for so long, the average American will lose approximately $70,000 in lifetime income as a direct consequence of what happened in 2008. Not the wealthy, not the bottom, the average. You, your neighbor, your coworker. $70,000 each, permanently. And that's on top of everything else. But here's where the story shifts from tragedy to something darker, because the losses were not shared equally, not even close. Households in the bottom 80% of the wealth distribution, that's 4 out of every 5 American families, lost 39.1% of their net worth between 2007 and 2010. Almost 40% gone. The top 20%? They lost 14%. Already a different scale. But then the recovery happened, and this is the part that transforms this from a story about bad luck into a story about something more deliberate. In the first 2 years of the economic recovery, 2009 to 2011, every dollar and more of aggregate gains in household wealth went to the richest 7% of households. Every dollar. Their combined net worth rose 28%, from $19.8 trillion to $25.4 trillion, while the other 93% of American households, the ones who had lost 39% of their wealth, were still underwater, still unemployed, still in foreclosure proceedings. The bottom fell harder, the top recovered faster, and the gap between them expanded during a crisis caused by the top. This is not complicated math. This is theft with paperwork. Why did the top recover and the bottom didn't? Because the Federal Reserve solution, zero interest rates and quantitative easing, inflated financial assets, stocks, bonds, real estate, and premium markets, things owned disproportionately by the wealthy. The middle class's largest asset, their home, remained 30% below its 2006 peak nationally for years. The cure for the wealthy was the disease for everyone else. Nearly every dollar in household wealth recovery went to the rising value of financial assets, and financial assets are owned by the people who already have wealth. It's a perfect circle, a closed loop. The plan was never to lift the bottom. The plan was to stabilize the system, and the system serves its architects. The jobs. Let's not forget the jobs. 7.5 million. Between 2007 and 2009, 7.5 million jobs disappeared from the American economy. The unemployment rate doubled from under 5% to 10.1% in October 2009, and it didn't snap back. It stayed above 8% until September 2012. 3 years of unemployment above 8%. And by September 2012, long-term unemployment, people out of work for more than 26 weeks, was the highest it had been since World War II. Not since the 1990s recession, not since the 1980s downturn, since World War II. These weren't just statistics. These were 7.5 million families recalculating their entire future based on a crisis that started in a boardroom they were never invited into. And the foreclosures. Nearly 10 million American homeowners lost their homes between 2006 and 2014. Let me make that concrete. Foreclosure filings, 717,522 in 2006, 1.3 million in 2007, a 79% jump. 2.3 million in 2008, another 81% jump. 2.8 million in 2009. From September 2008 to September 2012 alone, approximately 4 million completed foreclosures. Who were these people? Over 41% of foreclosed borrowers were under 40 years old, first-time homeowners, People who had entered the market during the boom because the system told them this was the responsible thing to do. Build equity, own your home, the American dream. 41% came from the lowest income quartile, the people with the least cushion, the people who couldn't absorb a single payment reset. They weren't reckless. They were exactly who the system claimed to be serving when it was building the machine. They were the product, not the customer. And here's the part nobody talks about enough. The damage didn't end with the foreclosure. Researchers found that the financial scarring persisted long after the foreclosure flag disappeared from credit reports. Persistently lower credit scores, significantly lower likelihood of ever owning a home again. The researchers compared the long-term impact to what happens when young workers first enter the labor market during a recession. Permanent reduction in earnings trajectory. Not a setback, a reorientation of life's entire financial arc. Downward. For actions taken by people in suits in buildings most of them had never seen. Okay, now the irony section. Buckle up. One person went to jail for the 2008 financial crisis. One person in the entire United States. His name was Kareem Sarageldin, a banker at Credit Suisse, sentenced to 30 months in prison for manipulating bond prices to hide $1 billion in losses. He returned $24.6 million in compensation. Not from Goldman Sachs, not from Lehman Brothers, not from Bear Stearns. Credit Suisse. And in the UK, where Northern Rock collapsed in a Victorian-era bank run and the government nationalized multiple institutions, 0 criminal convictions, 0 individuals prosecuted. The savings and loan crisis of the 1980s, which was smaller in scale, produced over 1,000 criminal convictions. The Enron scandal produced multiple convictions, including prison sentences for the CEO. The 2008 crisis, which destroyed $17 trillion in household wealth and cost every average American $70,000 in lifetime income, produced 1 conviction. 1 person went to jail, and he wasn't even from one of the firms at the center of it. But here's the irony that achieves a level of poetry I genuinely find awe-inspiring. The only bank criminally prosecuted for the 2008 crisis, Abacus Federal Savings Bank. Not Goldman Sachs, not Citigroup, not Bear Stearns, not Countrywide. Abacus, a small community bank in New York's Chinatown, serving Chinese-American immigrants. The Manhattan District Attorney charged Abacus and 19 of its employees with selling fraudulent mortgages to Fannie Mae. The trial ran for years. Abacus was acquitted in 2015. A community bank serving immigrants was the only institution brought to trial for the biggest financial fraud in American history, and they were acquitted. The architects of the actual disaster gave depositions, settled civil charges, and returned to their offices. The plan was never about accountability. It was about optics. Now let's talk about Goldman Sachs, because Goldman Sachs deserves its own paragraph. Goldman Sachs was selling CDOs to clients. Goldman Sachs was simultaneously building short positions against those same products, betting they would fail. In 2010, the SEC charged Goldman Sachs with securities fraud, specifically for creating and selling a CDO called Abacus 2007-AC1. Not the community bank, different Abacus. The universe has a dark sense of humor. Without disclosing that a hedge fund manager named John Paulson had helped design it specifically to fail so he could bet against it. Goldman paid a $550 million civil penalty, acknowledged that its marketing materials contained incomplete information, and went back to work. $550 million sounds large. Goldman Sachs had net revenues of $45.17 billion in 2009. You do that math. And then, the solutions. Oh, the solutions. To fix the financial crisis caused by cheap money and excessive leverage, the Federal Reserve launched QE2, $600 billion in Treasury purchases. Then QE3, $40 billion per month in additional asset purchases. Interest rates stayed at 0 for years. The intention was to restore economic growth, The mechanism was to inflate asset prices. And inflate they did. Everything went up. Stocks, bonds, premium real estate, the assets owned by people who already had money. The people who'd lost their homes in foreclosure were thrilled, I'm sure. Today, there are more renters than homeowners in 47% of major U.S. cities, up from 21% in 2006. Median home prices nationally are more than 50% above where they bottomed out after the crisis. The housing bust of 2008 didn't create affordable housing. It created a generation of renters who are now being priced out of the same market they were foreclosed from. The cure became the disease. The solution to the housing crisis made housing less affordable than it's ever been. And the political apparatus? Financial firms contributed a record $476 million in political donations in the election cycle during the crisis debate, more than double the second-largest donor sector. Goldman Sachs alone gave $5.8 million, followed by Citigroup and J.P. Morgan. The same firms receiving bailout funds were simultaneously funding the political campaigns of the people deciding how large the bailout would be. But I'm sure that's also a coincidence. Executive pay. Let's end the irony section with executive pay, because this one genuinely deserves a moment of quiet reflection. From fiscal 2008 to fiscal 2010, during the crisis and its immediate aftermath, total annual compensation paid to C-suite officers at major financial firms rose 37%. During the recovery from a crisis their firms created. Stock awards now constituted more than half of total pay, because stocks were going back up, thanks to the Federal Reserve's asset purchase programs. The same programs that barely moved the needle for median homeowners were making executive compensation packages explode. The men who built the fire got raises for surviving it. The neighborhoods that burned got one successfully insured Hope for Homeowners loan. Now, a comparison, because this story doesn't exist in isolation. It exists in a pattern. The savings and loan crisis of the 1980s. Smaller scale, different product, same structure. Deregulation, the Garn-St. Germain Act of 1982, gave thrift institutions new freedoms to invest in risky assets, particularly commercial real estate. Leverage increased, speculation increased. The institutions collapsed. The government bailout cost approximately $130 billion in taxpayer funds. But, and this is the critical distinction, the government also prosecuted. Over 1,000 individuals were convicted. CEOs went to prison. The regulatory response, the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, had actual teeth. Then came the Gramm-Leach-Bliley Act of 1999, which dismantled the Glass-Steagall separation between commercial and investment banking, and the Commodity Futures Modernization Act of 2000, which ensured that derivatives, including credit default swaps, would not be regulated as securities or as futures. The deregulatory infrastructure for 2008 was built in the aftermath of the S&L cleanup. The lesson from the 1980s was, next time, build a bigger machine. The lesson should have been, don't build the machine. Nobody wanted that lesson. That lesson doesn't pay $377 million. Charles Kindleberger, in Manias, Panics, and Crashes, one of the foundational texts of financial crisis history, documented the pattern across centuries. Displacement, boom, euphoria, distress, revulsion. The mechanism changes, the sequence doesn't. And in virtually every case, the resolution involves government intervention that protects creditors, the institutions, while debtors, the homeowners, the workers, the middle class, absorb the loss. The pattern is not accidental, it is structural. Carmen Reinhart and Kenneth Rogoff spent years documenting 800 years of financial history. Their central finding, the phrase, "this time is different," precedes virtually every major financial collapse. In 2006 and 2007, the arguments were specific. Housing never falls nationally, too many local markets. Securitization has so broadly distributed risk that no single failure can be systemic. The Federal Reserve has the tools to manage any downturn. All three claims were falsified within 18 months, and the IMF, with the diplomatic restraint that characterizes international financial institutions, noted that a lack of fundamental changes in banking and financial markets worried many market participants. Worried many market participants, which translates roughly as nothing was fixed, everyone knows it, nobody with power cares enough to fix it. So, what should you be watching for right now? Because if you think this was a once-in-a-generation event produced by uniquely stupid or uniquely greedy people who no longer exist, you haven't been paying attention. Watch household debt. Before 2008, U.S. household debt hit 130% of disposable income. That ratio rising again, particularly in mortgage and consumer credit, is the first alarm. Federal Reserve Z.1 Financial Accounts publishes this data quarterly. It's public. Most people don't look at it. Watch commercial real estate. Office buildings sitting half empty across the country. Retail centers hollowing out. Regional banks, not the Goldman Sachs behemoths, the smaller community and regional banks hold concentrated exposure to commercial real estate loans. Delinquency rates in that sector are the 2024 version of the 2007 subprime warning. When CRE delinquencies start climbing above 5% at regional banks, the S&L crisis framework becomes very relevant very fast. Watch wealth concentration ratios. The fact that virtually every dollar of post-2008 recovery went to the wealthiest 7% means the middle class enters the next downturn with dramatically less buffer than they had in 2006. Net worth concentrated in financial assets rather than in real wages and housing equity means any market correction hits the bottom 80% without a floor. The Federal Reserve's Survey of Consumer Finances, published every 3 years, tracks this. Read it. Watch the shadow banking system. In 2008, investment banks and hedge funds operating outside deposit banking regulations were able to hide leverage and risk through complex off-balance sheet instruments. Today, private credit funds, CLOs, and non-bank mortgage originators fill the same structural role. Same opacity, same leverage, different letterhead. The Financial Stability Oversight Council publishes annual reports on this. The numbers are in there, the attention is not. And watch collateralized loan obligations, CLOs. These are the modern CDO, products backed by leveraged corporate loans, often rated by the same issuer pays agencies, concentrated in the same institutional investors who held CDOs in 2007. CDO issuance went from $20 billion to $180 billion per quarter before the last crash. CLO issuance has been expanding at structurally similar velocity. History does not announce itself. It shows up in a new suit, hands you a rating sheet, and asks if you'd like to invest. Let's bring it home. The 14 bank CEOs. $36 million in personal stock purchases between 2000 and 2008. $3,467 million in personal stock sales. They were not building, they were exiting, in slow motion, with impeccable timing. And the exit cost 10 million families their homes, 7.5 million people their jobs, the average American $70,000 in lifetime income, $17 trillion in household net worth, and resulted in one conviction for a Credit Suisse banker and an acquitted community bank in Chinatown. The plan was never to absorb the loss. The plan was always to collect the upside and hand you the downside, wrapped in a product with a AAA rating and a name that sounds reassuring. Hope for homeowners. One loan, $300 billion authorized. One loan insured by July 2009, while $700 billion in bank bailouts moved in weeks. The bill always comes, just never to the people who ordered dinner. And the people who designed this system, they're still designing systems. Their successors are in the same buildings, with the same titles, with updated product names and modernized leverage ratios, assuring a new generation of regulators that markets self-correct, that innovation reduces risk, that this time is genuinely different. It isn't. It never is. It never was. And somewhere right now there's a Michael Burry reading the fine print on something everyone else is calling safe. The question isn't whether he's right. The question is whether anyone with power will listen before the 10 million families find out the hard way. You know who this story is about now. You know who built the machine, who profited from it, who designed the rescue, and who paid the bill. Most people will watch this, feel briefly outraged, and then go back to trusting the same institutions with the same incentive structures and the same absence of accountability. The pattern counts on that. It has for centuries. If you'd rather be the person who sees it coming, or at least understands why it keeps happening, that's what Money Never Learns is here for. New video every week. Same pattern, different suits. Subscribe buttons right there. Good thing we learned from history. We did learn from history, right?